Hey, this is Tyson coming at you with another TCon video. In this case, we're talking about the money market and how that works. So let's jump right into that. Here we have a picture of the money market and an explanation in green of things related to money supply and in red of things related to money demand. So we can start by thinking about money supply, and probably the easiest just to think about this is the monetary aggregate of M2, but if you think about M1, that would work too. Either way, we're talking about currency in the public's hands, and we're talking about checkable deposits or demand deposits. And if we're thinking about M2, then we're including savings deposits in this. It doesn't really matter which one you think about because either way, the following stuff all applies to money supply. So who controls, what factors influence how much money there is in our economy? Well, there's really just one factor, that's the Fed. And for any country, this is really the definitional characteristic of what it means to be a central bank, is that you have a monopoly on deciding how much money there is in circulation. So that decision is presumed to be independent of the interest rate. And what we're doing here is we're comparing nominal interest rates and the quantity of money that will be supplied in an economy, nominal interest rates, and the quantity of money that we will want to hold in the economy. So that's really what each of those two curves represents. So the green one is nominal interest rate, at various nominal interest rates, how much money will there be in the economy? Well, the Fed decides. So really what we say is that the quantity of money the Fed decides there will be is independent of the interest rate, and the way you graph that is the Fed says there are $11, so you graph X equals 11, and that's the kind of line that you would have. So it shows up as a vertical line, which is a little atypical for a supply curve. And anytime you have to draw the money market, it'd probably be expected that one of the points in the scoring rubric would be telling you, hey, you better have a vertical supply curve. And then what causes it to shift? Well, only the Fed causes it to shift. The actions the Fed can take to cause it to shift are called monetary policy actions. And if they do any expansionary monetary policy, that would be causing money supply curve to shift to the right. And if they did contractionary monetary policy, then that would involve money supply curve shifting to the left. Now, you've seen practice in other places of what those tools are, but just for restatement here, if they did this action here, that could be an open market operation purchase of bonds by the Fed, and therefore they're injecting excess reserves into the banking system, and banks have more money to lend, and so therefore money is less scarce. Or that pushes down the federal funds rate, or the Fed could cut the discount rate or lower the reserve requirement. And on the flip side, if we were thinking about what the Fed could do to decrease the money supply as a contractionary policy, that would be this sort of a shift of the MS2 up here. That would be selling bonds, raising the discount rate, or raising the reserve requirement. We usually mark money supply with MS, or we can use supply of money, so S sub M or MS. Either way is a totally fine designation. Here, we're looking at the money demand curve, and here we can signal that with MD or D sub M. Either way, we're showing that this is the demand for money. And real quickly here, I'll go into this more in a second, but up here we want nominal interest rate, and we denote that usually with lowercase i's. There's a different market called the loanable funds market where we think about real interest rate, and we denote that with lowercase r's. So lowercase i's are good for interest rate 1, interest rate 2, that kind of thing. Down here we have quantity of money, and they're going to think of that as wrong if we put Q $sign. So we have to put Q money or Q sub M or something like that to signal exactly what we mean. Thinking about the demand for money, how does that work? That is indeed a downsloping demand curve, but it's important for you to think about the two components of money demand, and they stem from the two reasons people want money. Really, if you think about why you want money, it's no different than why everybody else wants money. It's either so you can buy stuff now or so you can buy stuff later. And you learned about the important functions money plays. Right now, I'm not thinking about the unit of account one, but I'm thinking about the medium of exchange one and the store of value one. So medium of exchange was about buying things now. I want money and it's useful because I can trade it for goods and services. So we'll call the amount of money that people want for that reason to be transactions demand. They want this money to do transactions. Usually we assume that that component is vertical because that's money I need to buy groceries and pay my bills supplies, and that's not so much dependent upon the interest rate. And what does it depend on, though? That depends upon how much stuff costs and how much stuff we're all buying. And fortunately, we have fancy aggregated terms. Price level is how much stuff costs in general, and real GDP is how much stuff we buy. So in the same way that if you needed money to buy stuff, the amount you need would be influenced by how costly things were wherever you were going to be shopping, and also by how many things you needed to buy. So that's basically the things that cause there. If you think about it, these are the axes of the ADAS graph. And so if you think about it, whenever AD shifts to the right, money demand would increase. And when AD shifts to the left, then money demand would decrease. Mostly, though, the tricky bit about money demand is the asset demand for money. So there we're thinking about why people want to hold money in this case is they want to hold money as a store of value, so a way to preserve their wealth into the future and in a liquid form. And the amount of money people want to hold for storing it to use in the future is dependent upon the interest rate. So let's think about why that might be. The key way to think about it is you have lots of options when you want to hold your wealth for the future. And you could hold those in really liquid assets like money, or you could sacrifice some liquidity for an expected gain. And this trade-off is all about what the asset demand for money is really about. So instead of thinking of all the different ways you could hold your wealth for the future, just think about two. Would I rather hold my wealth for the future as money or as bonds? Remembering bonds, of course, are not money, and bonds are also cheaper when interest rates are higher. Bonds are more expensive when interest rates are lower. So parts of the graph down here at low interest rates, those go along with expensive bonds. And parts of the graph up here with high interest rates, those go along with cheap bonds. So would I want to hold my wealth for the future as money or as bonds? Well, if interest rates are high, then buying a bond is cheap. And if I buy a bond, my wealth can grow pretty quickly. So buying a bond is pretty attractive. And holding money is actually pretty costly because the value is not going to increase. But if I buy something else, it would. The sacrifice up there, if I choose to hold money, is pretty high because I'm sacrificing a lot of rate of return if I were to buy a bond. If we think about a contrary case down here where interest rates are low, bonds are expensive. If I put my money in bonds, it does not grow very fast. My wealth won't increase. My purchasing power won't increase when I get back more money later when I sell the bond. It won't be very much more. So in that case, I'm assuming the risk that the bondholder won't pay me back and the loss of liquidity because a bond is less liquid than money, but I'm not really gaining very much. So I don't really want bonds in the low parts of the graph. I want to hold more money. And so these three ideas here help us understand why asset demand would be downsloping. So if we think about it, any given interest rate, how much we want to hold for transactions plus how much we want to hold for asset purposes, we would end up with this downward sloping line. When you have to draw the money market, it is predictable that I will be checking and that your AP graders down the road will be checking for whether you have a vertical money supply curve, whether you've identified that we've got the nominal rate of interest, whether you have money demand sloping down, and then the most common thing they want to test you for is, do you know that when the Fed buys and sells bonds, money supply increases with expansionary policy to push down the interest rate or decreases with contractionary policy to push the interest rate up? Slightly less common are situations where because the price level increased or real GDP increased, you'll need to know to move money demand to the right. Or maybe they'll give you a prompt that says, for whatever reason, the public wants to hold less money. And so then, of course, what you would want to do is say, well, I want to find that money demand curve, and let me shift it down here to the left. And I'd label that MD2, and then I'd have a new lower interest rate down here. So that's the way that short-term nominal interest rates, you might think of this market as overnight lending, perhaps between banks, so that they could meet their reserve requirements in the federal funds market. So this is sort of where the nominal federal funds rate gets determined. And because it's short-term lending and borrowing, we're not really worried about the effects of inflation from one day to the next. And bank-to-bank lending often is overnight lending and paid back the next day, or sometimes certain types of arrangements that the Fed or banks have with each other will be for 7 or 14 or 21-day loans. So these are time horizons over which we don't really worry about needing a inflation-adjusted interest rate. But that's something we can explore, the differences between this and the loanable funds market, which is where the real interest rate gets determined. Hope that helps you with some basic money market mechanics.